I'm very pleased to introduce Dr. Mathias Terheggen of UBS AG. Dr. Terheggen is the head of philanthropy services at UBS, a dedicated advisory unit that provides a comprehensive range of services to high net worth individuals engaged in philanthropic activities. Prior to joining UBS, he was engagement manager at McKinsey & Company Switzerland, where he served Swiss clients in the area of marketing, high-tech, before focusing exclusively on social sector topics. Mathias holds a PhD in physics from the Swiss Federal Institute of Technology. Mathias, please.
Thank you very, very much. This certainly is a very fast-paced conference. And thank you. Okay. I want to sincerely thank the organizers for the opportunity to stand here and present. I'm doing this on behalf of UBS, a bank. I'm not here by myself. I'm here with several colleagues that are equally qualified to talk about what we're doing in the area of philanthropy. You identify them by the secret handshake and the fact that they're wearing ties, as opposed to anybody else here. And why am I standing here? Because UBS has a team of about 35 people globally that are dealing with philanthropy. This is not the bank's philanthropy, that exists as well, but it's actually what the bank does to help its clients to engage on the topic of philanthropy. And it is in that capacity as a philanthropic advisor that I'm standing here and talking about the topic of social investing. And I want to approach it from two angles. The first angle is, as I said, that of a philanthropic advisor, which deals or helps with the question of, should I be investing at all? Or should I rather be grant making, as I'm sure many of you have done in the past. And very often this question comes as a little bit of an end of pipe discussion to us, where we have people that have successfully been philanthropically active for a long time. They've been grant making, they've established the capacity to do that in a very professional manner. And now there's that new thing, social investing. And they're asking themselves, well, should I do that? Should I replace my grants with social investments? And I think there's a certain danger in approaching it from that angle, because for one, it might not deliver on the promise of bringing new funds to the challenge, because if you're replacing grants with investments, you haven't added any funds yet. And secondly, the decision whether to invest or to grant make is much more fundamental. It actually goes back to a very philanthropic strategy, to the base of what you're doing. And so this is what I would like to do first. How do you arrive at an answer to the question, should I invest or should I make grants? And so imagine yourself being at the point of having identified your vision. You know the what, the where, the who of your philanthropy. You know your skills, capacities, your motives and experiences that brought you to that point. And now you're asking yourself, so how am I now going to create change? And there's fundamentally three ways that philanthropy can actually create change. Here's the question. You can either add resources. This is particularly appropriate in scenarios where you know that something works well. There's an organization out there doing it already. And so you don't need to reinvent the wheel. All you need to do is make sure that there is more fuel available for the existing effort so that they can actually scale. One of the examples I have here is that of the Wellcome Trust in the UK that actually funded the Genome Project. That was ongoing, they knew it was working. There was a social objective in this, which was to make sure that the information on the human genome stays in public space and doesn't become the property of a private company, for example. And so as a Wellcome Trust, they financed that. The second way of creating social change is by building capacity. You know that something's proven, but there is not enough capacity out there to generate the social impact. And so you can invest your money, or you can give money to building that capacity. The example I've chosen here is HealthPoint. It's a chain of hospitals in India that are providing basic healthcare services, and they're doing that in the combination of selling water. And people need water, so they actually come there, they buy the water, and in the context of that purchase, they're actually getting primary healthcare. And this is done in a financially sustainable fashion. You can actually invest in HealthPoint if you want to. And then finally, what you can do is you can campaign for change. You need to do that especially in areas where the solution isn't known yet. There is an issue, but nobody knows yet how to solve it. And so you're trying to build an alliance around it. And the example I've chosen here is the one from John Doerr, who actually realized that the white lines in the middle of the road, which is what marking on streets started with, had one disadvantage. At night, actually, people tended to go on that white line because that way they were sure that they're not falling off the road. Unfortunately, if they started doing that in pairs in opposite directions, that led to a lot of lethal frontal collisions. And he was convinced of that, and he built an alliance around it, and he's actually sort of the person that we owe those white lines to the left and the right of the street to, and that have prevented millions of deaths in the world. And he has built an alliance around that issue. Now, an important point here is, and that's why I've chosen these examples, there you don't have an answer yet on whether you want to create social change through grant making or through investing. For all of these three approaches, both is possible. So how do you find out if it's investing or grant making? Well, as I said, it's in your strategy, or as it's called, the theory of change. And the theory of change that you're building based on the vision you have is influenced by an approach you potentially want to take, and you're starting with selecting a quantifiable, clear goal of what you're trying to achieve. So basically you're putting a number to a year, and you're saying, this is what I want to reach. The next thing you're doing is you're mapping out all the activities that might lead you to your goal. Is there a laser pointer in that thing? Possibly, huh? Okay. Thank you. So if this is your goal, then there's a number of activities, and each activity will lead to additional activities that will actually enable it. So imagine, if your objective is to do something about climate change, you might either have the option of supporting the substitute of existing sources of energy with new ones, or you might look into reducing the use of existing energy sources, and that would already be the very first decision, and you can basically then break that down all the way to your funds, where you're ultimately then looking at the decision, okay, which of all these options do I now support? And you have to choose a path around that, and that will be your theory of change. It will map into a logic chain, and the logic chain then ultimately reads like, well, the resources I'm investing will power certain activities, these here, in this example, that will yield certain inputs that will lead to outcomes, and that will ultimately then create the impact that I'm trying to achieve. Now, obviously, the big question is, well, some of these paths might include the option of social investing, and others might purely build on grant making. So how do you decide that? Now, before I go into the details of how you decide that, I want to give you one example of how they can be very equivalent. And this is actually a real case example. It is based on a foundation that the bank has, the US Optimus Foundation. And it started out with a vision of bettering the lives of children in a particular area of Africa through creating access to higher quality education. And the goal that was attached to it was that there should be several thousand children which are positively affected by the end of 2013. Now, here is the path that was chosen from a grant-making perspective by the foundation. They basically said, why don't we take about 450,000 Swiss francs, you mark them for an education project in Western Africa, thereby allowing us to do the following activities, which is developing a toolbox, or the knowledge to start with, that will then lead to a toolbox that will contain a number of interventions which are proven to positively affect education. So why don't we do that? And that will allow us, once we have that, which will be in about 12 months, which will be in about 12 months, to provide this toolbox to about 32 schools, and in those 32 schools will reach around 18,000 children that will experience an increase in literacy and numeracy by about 2 grade levels. This is then the outcome, and the impact, apart from positively influencing the society, is, among other things, that you've basically proven the scaling power of knowledge. This is a purely grant-based intervention. Now, there's an alternative to this, because all this is based on the work of James Tooley, who's a professor who's very successful in education, who has that vision that poor people are willing and able to pay for education. Even if they're very poor, they can afford a couple of cents each day, which they're willing to put in the school where their children are going if they're convinced that it's a better school. And he is in the process of successfully proving this, and so therefore, you have the option as an investor to actually, instead of making a grant to him, you can invest into him. And one option you have is that you can invest about $180,000, which will lead to the build-up of 3 private schools in the outskirts, in the slums of Accra, basically. And there are about 1,500 children, which at this point did not have access to education, or only to very, very poor public education, will now receive private education, which will then lead to significant increases in reading and numeracy proficiency again. Plus, on top of it, he's currently expecting a return on investment of about 20% in what he's doing. The impact is that you have proven that the sustainability, well, that you actually can create social impact by investing and do that in a sustainable fashion. And the point I'm trying to make here is, it's the same vision, it's ultimately a similar sort of goal and impact that you're expecting, but you can take 2 completely different paths. So how do you decide which path you want to take? And there's a number of criteria. By the way, I'm drawing here on a toolbox which we use to guide people through their sort of philanthropic journey. It's called the Philanthropy Compass, and if you're more interested in that, I'm happy to share more of the frameworks we're using there. So on the one hand, there's a number of sort of criteria for decision making, whether you want to invest or whether you want to grant make. A lot of them are personal. So obviously there's something about time horizon. Investments, at least at this point in time, tend to be fairly long-term, and so you want to make sure that you're in it for that time period. There's something around risk and innovation appetite. Grants are a well-proven social intervention methodology, and so therefore, if you want to be a little bit more on the safe side, if, for example, certain reputational concerns are among the things you wonder about in building your philanthropic approach, then this is something to be taken into account. The level of involvement is something, how much time can you actually dedicate to what you're doing. There is obviously an aspect of tax and wealth planning. Liquidity is an important aspect. How long can you tie in money, for example? There are a couple of factors that are relating to the way you're creating impact itself. And this is really then sort of already going into that decision tree that I showed before. Are you taking the left path or the right path? That's where it really then touches the subject matter that you're dealing with. One is when you're investing, you're creating a completely different mindset in the recipient than when you're making a grant. I'm sure many of you have experienced that. If somebody loans you money or if somebody invests in you, you start having a very different relationship to that person than having received a gift from that person. And sometimes that can be very positive. And so obviously that is part of the consideration. Then there might be certain things which are very difficult to do with a grant. So for example, the provision of basic infrastructure, which can be tremendously helpful in a social context, is something that is often difficult to do with a grant, especially if you're publicly fundraising. Raising money for a road is tough. Investments might here be easier. You're increasing your effective spending rate when you're investing instead of making grants, which means if you're, for example, basing your philanthropy on an endowment, the way you're investing your endowment might already contribute to the social impact you're generating, and thereby your effective spending rate towards a social goal goes up. You're obviously recycling funds because you're getting them back and you can use them multiple times. And ultimately, and I think that's one of the big promises, you're possibly activating new funds. You might draw people into the game that currently don't have the resources to give money away. in a philanthropic context, but they're able to invest. These are considerations. There are a couple more which are not listed here, which are then cause-specific. There are certain areas which will continue to be extremely difficult to access through financially sustainable investing. Disaster response, palliative care. There are various examples which it'll be tough to build business models around this. And if this is the area you're passionate about, then investing might not be what your theory of change is building on. Another very important piece of that is the availability of different sources of funding. If you're currently making grants, there might be a reason for it. And one of the reasons could be because nobody else is making grants. And so maybe there's a value in just keeping that up, because if you would change to investing, then the source of grants would basically dry out, and there might nobody who's actually replacing it. So that's one of the considerations. The other area to think about when you're making the decision whether you want to invest or grant make is the consequences it has. One, in terms of your positioning and communication. If you already have an existing organization that is in grant making, your stakeholders have a certain perception of what you are. If you're now starting to go into the area of investing, that is a communication challenge in terms of explaining them why you're now doing things completely different. Needs to be taken into consideration. Obviously, there are operational consequences. If you're doing this through an organization, then all of a sudden there might be new activities like running a due diligence on a potential investee, which so far nobody has done in your organization, could be. Which then ultimately, of course, leads to organizational consequences like new skill sets and so on. Is the organization you currently have as a philanthropist geared towards making investments? Might not be the case, and the consequences could be, for those that are currently active for you, quite fundamental. So this is a little bit sort of the decision process that we would go through with a philanthropist who's looking at an answer around the question of, well, should I invest or not? Now I'm going to change heads, and I'm going to put another one on to answer the question, well, okay, I've decided I want to invest, what should I use as a means of investing? And this is a little bit more that of so to say, an investment advice, but in the context of social intervention. And something to maybe say up front is boundary conditions, because this is an extremely large space. One, I'll be looking at a scenario where at least financial sustainability is a given. So I'm ruling out right now investing as a philanthropic tool, which even if it's 20-30% loss making, might still be better than 100% grant-based intervention. But for the argument's sake, I'm currently excluding that. I'm looking at where you're at least receiving 100% of your invested capital, ideally even a return on top of it, to create financial sustainability. And the other thing, you may forgive me, I'm generalizing a lot now. We're living in a world where corporate equity is considered safer than government debt, for example. So our whole understanding of the investment space is currently under heavy review, and so therefore I will make certain generalizations towards different asset classes where I'm fully aware of the fact that, especially given the juvenile space of the sector, we will always find an example where we can say, but it's different here, and that's most likely true. But in order to provide some guidance, I think we have to generalize. So, what should I invest to create social impact? I think you've all seen this many times. There's basically the option of maximizing your social return, and there's the option of maximizing your financial return. And somewhere up there are the grants, and somewhere here are the conventional investments, the for-profit investments that will generate a return, and then eventually you might take those returns and actually put them up to here. In between, there is, well, it's probably fair to say, a zoo. Market-related, mission-related, program-related investments, which can be below market rate returns, above market rate returns, and they come in various asset classes, ranging from debt to equity. There is a loan guarantee, something that many philanthropists like to use because you're not using your capital, but you're putting a guarantee up for an NGO. You're then going into the area of credits. Credit lines are an interesting vehicle to help NGOs, just as one example. Many of the disaster response organizations need immediate funds when disaster strikes. They get guarantees from governments that funds will come, but the funds are not there yet. Providing them with a line of credit can be a very powerful way of making an investment that will enable them substantially. There are all the bonds, the Gavi bonds, the Calvert, and so on. We're then more moving towards obtaining equity, real estate. There is the, what is it called? The Lime Northern Forest Fund that, for example, bought a lot of forest land and then put a law on it, basically saying you can only use it in a sustainable manner. That's a way of creating social impact. And then ultimately, of course, there's the whole private equity space. And what's probably fair to say is that if you're more to the left of that spectrum, you're talking about a space that is sort of fairly established. It's readily available. The whole microfinance space, for example, is happening to the left of that spectrum, and there you can get many sort of off-the-shelf products as a social investor. It tends to be more low risk. Very often it's secured. And to the right, your fewer option access is more difficult, and they tend to be more high risk. So one thing that I think, or there's a couple of things that one can say across the spectrum when one is looking at the sector of social investing, and that's that it's a sector in its infancy, at a very early stage, and that has a couple of challenges for the investor that need to be kept in mind. Some of them are intrinsic to social investing, and they will probably not go away over time. One is the investors your tend to be high risk. They tend to be basically not boundary conditions can be unclear and so on. That's part of just going somewhere where the situation is very difficult in creating social change. The sector has challenging economics per se. From an investor's point of view, it's ideal to make large investments and few of them because that lowers your costs. From a social point of view, you want to make many investments which are small. That's a contradiction in itself. So the typical social investment these days, a million, a few million, that's sort of where sustainability from an investing point of view comes into play. If you're much smaller than that, you're probably doing something which might not be financially sustainable from an investing point of view. Again, please, I know there are a few exceptions, but generally I think that's a fair statement. Another thing that drives costs up is that it's still a very fragmented sector, which means the cost of finding your investor are high, or the other way around, for the investor to find your fund, for example, are high. And then there's the whole challenge of performance measurement, both financial as well as social, and that will probably remain. There's a couple of challenges which are in the environment, and I think they will go away over time, and the fact that you're all sitting here and discussing this is basically the best proof that the solution is not far away. There's a lack of standards, infrastructure, jargon, that people are using the same language in that space, but that's in the making, and ultimately here, whoever comes out first with big solutions will probably set some standards. A limited track record of managers. There are not too many impact investment managers out there yet. There need to be more. And in particular, because there is a reverse risk, there's a little bit of an observation that some investors that weren't necessarily heading for the impact investing space originally are starting to take it up because it's a very en vogue term currently. And so there are certain, so for example, venture capital that realizes that when you label it impact investing, it might give you access to some people that otherwise wouldn't necessarily look at what you're doing. So I think building a track record quickly is key. Regulatory constraints as a foundation in many locations, it's extremely hard to make these investments and maintain your charitable status. And then there's the market. A very limited deal pipeline is one of the challenges that investors are currently looking at. Both in quality and quantity. That's, although probably most quickly improving. Liquidity and exits are a major topic. Many of the social investments, you buy them and you'll have them for a long, long time because they're not freely tradable, which not necessarily is a problem for the social investor because you're in it for the long term anyway. And then access for investors can be very difficult. So a whole number of challenges in a sector. Some of them will disappear over time. If one says, I don't care, I don't want to wait till all of this matures and becomes a nice risk-free option for my portfolio, I want to be in it now, what are the questions that one should look at? And there are basically, again, two of them. Should I go into debt or equity? And the other, should I directly invest or should I indirectly invest? As with all big questions, the answer is, it depends. It depends on the kind of investor. There's a number of things, and in the interest of time, let me go right into sort of the two questions and what might be help in making this decision as a social investor. The first one is, should I go into debt or equity? Both are options. And the criteria that we're looking at are around sort of the possibility to actually do it, the ease of implementation, I think is a very important one. For example, how easy is the access? Do you need to be a well-proven expert on a certain topic before you can actually start making investments in that space? If that is the case, then I think it's fair to say the access is not easy. Are there options out there, and can they take up certain volumes? I mean, we're all hoping for institutional investors to at some point enter that space. They're looking for very large volumes, and currently there's nothing out there that can take these large volumes up. Financial feasibility, delineating a little bit what ultimately ties together is risk, cost, liquidity, and return. And the first two you want low, second too high. And then ultimately the social impact, can you influence it? Can you make sure there's really a social impact? And how big can it ultimately be? And as I said, with all the risk of generalizing, here's a little bit what the current view looks like. Debt is easier to access. There are more solutions out there. I mentioned microfinance as one. It tends to be lower risk because very often it can be secured, or you have a pretty good understanding of how much money is at stake. There you have a foreseeable time horizon, and that helps in terms of access and feasibility. Where equity becomes very strong is, on the one hand, when you're looking at high returns. Obviously, this is due to the fact that there's a higher risk in it, and so you get that back as a potential in the return, as a potential. And in terms of social impact, equity is ultimately the personal involvement as an investor in the social enterprise or organization that you invested in. And what you buy with the investment is the right to enter the discussion. And that means you can directly influence the outcomes of what is done there. So there is more influence, and there is more potential social return ultimately to be gained. So that a little bit as a guidance on debt versus equity. And the other area is direct versus indirect investments. The criteria are pretty much the same. A direct investment would be you're going out there, you're finding yourself a social enterprise, and you're giving them money. You can do that alternatively through a fund, or you can actually take a fund-of-fund structure, thereby reaching even sort of larger scales. But they're at very different stages in terms of development, and they have different advantages. I think on the direct investment, it is fair to say that there might be a lot of organizations out there that are seeking investors. And many of you might receive requests at a regular basis to make an investment. It comes with a promise of high potentially financial return and certainly social return because you'll be directly involved. Unfortunately, the one crux with that is, as I mentioned before, in terms of access, if you're going into the field, especially if it's a country that might be very far away from here, for example, somewhere in a developing economy, and you're making a direct investment, really being on the ground, managing that investment is extremely time intensive. And if I'd be a bit cynical, the only ones that we're currently seeing out there that are actually doing it as direct investments are basically absolutely wealthy, sort of independently wealthy, that have the means of dedicating a ton of time to it. And they're doing it because they're really excited about it. But for anybody who, for example, is maintaining a regular professional career on the side, this is probably extremely difficult. So they're quite strong on the social impact. The funds are probably a well-balanced means of making an investment, because with a fund you still know pretty much what you're getting. The fund might specialize in education, and you can decide whether that aligns with your philanthropic vision. And if it does, then a fund is a good means of making an investment. And finally, there's fund of funds, which are basically investing into various funds, across various funds and geographies. And what they offer is a significantly decreased risk, because they're highly diversified. Obviously, they tend to have certain economies of scale, so in terms of efficiency, they can be quite good. What else is there? Well, they can obviously, due to their nature, absorb large volumes. So if you want to put, a couple of 10 million, for example, in a social investment, a fund of fund might be the more feasible option. And so they tend to be quite successful sort of in the ease of implementation, or feasible ease of implementation and areas of financial considerations. They have one other advantage to be kept in mind. They might make some of the more unpopular decisions of investing, which as an individual could be very tough. So if you're truly investing, if you see something defaulting, you need to pull out. Now, unfortunately, the investments you're pulling out from might be extremely successful as a social enterprise. They might have great social impact, but from an investing point of view, you have to make the decision that in your portfolio of activities, the money might be better invested somewhere else. That's an extremely unpopular decision. It's a very tough decision to make, and intermediaries, for example, help with that. Because unfortunately, it's the downside of really taking an investment approach that you, strictly speaking, are only allowed to put the money where it creates the most impact and financial sustainability. And so I think there's a few minutes left. Okay, I'd like to go into one example of a fund that was recently launched and take you a little bit sort of through the considerations, which are the ones of a bank, but I think there is an educational value in this, so I wanted to share them. The objectives were to have a high social impact, because I think at this point in time it's actually a lot around proving there is social impact possible through investing. And if this is not there, then I think one hasn't really made a point. Then obviously it needs to be quantifiable, so it's not just telling a story and hoping that people believe it, but being able to actually measure it. A certain scale needs to be reached. I think it's time that we're going beyond the pilot stage of impact investing fund, and that we're trying to move more towards the mass markets, and that is only possible if there is volume. It then needs to be easily accessible. So it shouldn't be only people that have built years of expertise in the area of healthcare, for example, and now make qualified investments in that space. There needs to be a certain risk diversification. I think that's a tribute to the fact that, well, on the one hand, it's a bank, and on the other hand, if you want to go mass market, I think investments need to become, at least at the forefront, a little bit easier. And financial sustainability, I said it from the start, is an objective as well. And last but not least, which sounds a little bit sort of like the paradox of the squared circle, unfortunately, especially the larger investors tend to be philanthropists with strong views on where they want to create a social impact. And so if you want to use it as a philanthropic tool, you need to be able to customize a little bit the social impact that you're getting out of it. So the approach that was therefore chosen is one where equity was selected in the strong conviction that if you ultimately want to steer your investees towards creating a lot of social impact, then equity is the most sort of the biggest door you can open to be part of that discussion. A dedicated impact measurement, I'll come to that in a minute. Large volumes and easy access, fund of fund here, I think, is the way to go. Please note, by the way, large volumes, for example, could be achieved through debt as well, but then if you're doing debt, you're actually you're reducing sort of the amount of influence you have on the social impact. So this is why this combination was chosen, but I think it's an example of how you as a social investor might then take another route. But by going through these different criteria. And then finally, as part of the diversification and financial sustainability, going across geographies and sectors was decided, and a very experienced fund manager was chosen. What the solution then looks like is that you're ending up with a fund that is investing equity into small and medium-sized enterprises in countries with a per capita GDP of less than $10,000, so mostly developing and emerging economies. That are active, the SMEs are active in 6 sectors, the sectors being education, healthcare, agriculture, basic infrastructure, clean energy, and financial inclusion. It's measuring its social impact to 21 indicators, which are not only measured, but they're actually used to compensate the fund manager. So success is then actually tracked, and it's tracked towards a baseline, what's happening in the country, which has the advantage that you're not only carrying a positive momentum in the country into the performance of your fund, but you're actually looking at, am I making a difference? It's financially sustainable. There could actually be an attractive return due to the fact that it's a fairly, in principle, it's a high-risk investment. And investors have the option of picking only certain parts of the fund. So for example, you can only take the part that relates to education, if you're saying I'm complementing here my work in education. It contains certain compromises. So if you're doing SMEs, for example, small and medium-sized enterprises, it is not NGOs, it is not non-profit organizations, it is not social entrepreneurs, for example, only to a limited degree, only the ones that are already quite successful. But that's basically a commitment to creating a well-balanced option, ultimately. And with that, I'm reaching the... And from a recipient's point of view, if you have the choice, I think most of the cases you'll take the grant, you'll not take the investment. And all of a sudden you have a competition where it's actually not very helpful. Seen this on various occasions, and I think discussing more investing as part of a philanthropic strategy than standalone will lead to answers that show how they can complement each other. How an investment and the grant actually then go hand in hand instead of being in competition for the same recipient ultimately. And I think, again, you know, this is one of the places where this kind of discussion will, I think, ultimately happen. So with that, I hope I could provide a little bit of guidance, and I'm very happy to answer any questions now or later, should there be any. Thank you very much for your attention.